For decades, the American dream came with a specific set of instructions. Do well in school, get a stable corporate job, and funnel 10% of your paycheck into a 401k for 40 years. If you followed those rules, you were guaranteed a comfortable finish line. But that finish line is shifting. The cost of living is accelerating far faster than average wages, and the target retirement age is moving toward the early 70s. When millions of people play by the rules and still struggle to survive their final years, the problem lies in the underlying math. The traditional retirement model is failing to account for modern economic realities. A generation of workers is reaching their 60s only to realize their savings are insufficient. They are entering their golden years not with leisure, but with the necessity of working indefinitely. The 401k is an artifact of a different century. To understand why it's failing today, we have to dissect why $1 million retirement is structurally designed to fall short of expectations. In the 1970s, the standard was the defined benefit pension. If you worked for a company for 30 years, they paid you a fixed percentage of your salary for the rest of your life. As life expectancies increased and the cost of supporting retirees climbed, these pensions became heavy liabilities on corporate balance sheets. Corporate America responded by introducing the 401k. On paper, it was presented as a way for employees to control their own destiny, but the financial mechanics tell a different story. This shift allowed corporations to offload the entire weight of stock market volatility and portfolio management onto the individual worker. This model provides a financial shield for the employer while leaving the employee entirely exposed. If the market crashes the year you turn 65, your timeline for retirement is destroyed. Beyond the market risk, the internal structure of the 401k contains a constant drain. Wall Street fund managers automatically collect management fees every single year, regardless of whether your account grows or shrinks. This chart shows the projected growth of a retirement account over 40 years. Within these funds, a management fee of 1.5% is common. Factoring in that fee, the lower line shows the result, permanently erasing a massive portion of potential growth. The worker provides the capital and takes all the risks of the market for 4 decades, while the financial institutions take a certain guaranteed percentage of the total wealth created. The internal math ensures the house wins regardless of the outcome. It sets workers up to bear the burden while managers take the first cut. Most financial planning centers on a single number, $1 million. Culturally, we've been told that hitting this target ensures a lifetime of security. This volumetric chart represents $1 million in purchasing power against modern living expenses. Due to structural inflation, that cash pile loses value daily. In high inflation environments, its utility is cut in half within 10 years, exactly when healthcare and energy costs peak. Taxes add yet another layer of complexity. Traditional 401k withdrawals are taxed as ordinary income, meaning your future standard of living depends on tax laws that haven't been written yet. Relying on a static number in a brokerage account ignores the reality of declining currency value and future tax liabilities. The so-called $1 million goal is a moving target that most people will never actually hit in real terms. Continuing to rely on corporate-managed passive savings is no longer a viable path to security. The variables have changed, and the strategy must change with them. Achieving financial independence requires moving away from the pursuit of a net worth number and toward the creation of consistent monthly cash flow. A fixed paper balance is vulnerable to the inflation we've already seen, as its value is static while prices rise. Cash flow assets are different because they are tied to productive value that can adjust over time. Real estate rents and business profits often rise alongside inflation, preserving your purchasing power. Similarly, dividend growth from profitable companies can outpace the fees that normally drain a 401k, keeping more of the yield in your pocket. Protecting that wealth also requires tax diversification. Placing every dollar into a tax-deferred account gives the government total control over your future take-home pay. By utilizing Roth structures, taxable brokerages, and physical assets, you can choose when and how you are taxed. This provides a layer of defense against future policy changes that could otherwise deplete your savings. Building a system of assets that generates income independent of an employer or a specific retirement age provides the control that a 401k cannot. It moves the finish line from a date on a calendar to a level of cash flow that sustains your life today.